Welcome to Module 2, Bank Reconciliation. The hotel's financial management starts in the front office. Of course, this responsibility is shared with the controller's office, but it begins with the accurate and timely processing of guest accounts. This chapter addresses the assembling and balancing of all financial transactions in the guest account and hotel department for each day of the year. This can be a time-consuming process for the night auditor, but it provides a balance of debit and credit entries to guest and departmental accounts, which include income and expense generating areas of the hotel. For our objectives for today are the following. Number one is identify and resolve financial and system discrepancies according to level of responsibility. Number two, implement financial systems and financial control systems in accordance with establishment procedure. And the last one but not the least, monitor systems and provide feedback. Bank reconciliation is a process performed by a company to ensure that its record, check, register, general ledger, account, balance sheet are correct. It's a document that matches the cash balance on a company's balance sheet to the corresponding amount on its bank statement. A bank reconciliation should be complete at regular intervals for all bank accounts to ensure that the company's cash records are correct. Otherwise, it may find that cash balances are much lower than expected, resulting in bounce checks or overdraft fees. A bank reconciliation will also detect some types of fraud after the fact. This information can be used to design better controls over the receipt and payment of the cash. Bank reconciliation reconciling the two accounts helps determine if accounting changes are needed. These are complete at regular intervals to ensure that the company's cash records are correct. Also, help detect fraud and any cash manipulators. A bank reconciliation is the process of matching the balances in an entity's accounting records for a cash account to the corresponding information on a bank statement. The goal of this process is to ascertain the differences between the two and to book changes to the accounting records as appropriate. The information on the bank statement is a bank's record of all transactions impacting the entity's bank account during the past month. Remember terminologies in bank reconciliation. Deposit in transit. Number one is a deposit in transit. Cash and checks that have been received and recorded by the company but have not yet been recorded on the bank statement. A deposit in transit is money that has been received by a company and recorded in the company's accounting system. The deposit has already been sent to the bank but it has yet to be processed and posted to the bank account. Number two is an outstanding check. Outstanding checks that have been issued by the company to creditors but the payment has not yet been processed. An outstanding check is a check that a company has issued and recorded in its general ledger accounts, but the check has not yet cleared the bank account on which it is drawn. This means that the bank balance will be greater than the company's true amount of cash. Number three is a bank statement. A bank statement deducts charges for services they provide to customers, but these amounts are usually relatively small. A service charge is a fee charged to customers for something specific, such as a bank charging a fee for using an ATM that's not part of its network, or a vendor charging a fee for making a payment with a credit card. It also may be called a customer service fee or a maintenance fee. Number four is interest income. Interest income is the amount paid to an entity for lending its money or letting another entity use its fund. Bank pays interest on some bank accounts. On a larger scale, interest income is the amount earned by an investor's money that he places in an investment or project. Number 5 is not sufficient funds or the NSF. Not sufficient fund when a customer deposits a check into an account, but the account of the issuer of the check has an insufficient amount to pay the check. The bank deducts from the customer's account the check that was previously is a term used to describe a check that is paid for by the bank because the check than the amount of the check. Insufficient funds is also referred to as a return check, a return item, a check that bounced, or a rubber check, since it was bounced back to the payee by the bank on which the check was drawn. Number 6 is bank errors. Bank errors are mistakes made by the bank. It could include the bank recording an incorrect amount. Bank errors are transactions that have been incorrectly recorded by a bank in a customer's account. These errors are usually found during the monthly bank reconciliation process conducted by customers who notify the bank to correct the indicated items. Check printing charges. Check printing charges, it occurs when a company arranges for its bank to handle the recording of its checks. Bank are the fee imposed by a bank when an account holder orders additional check stock. Number 3, or the third phase of this discussion, is the two parts of bank reconciliation. Number 1 is the bank statement. A bank statement is a list of all transactions for a bank account over a set period, usually monthly. The statement includes deposits, charges, withdrawals, as well as the beginning and ending balance for the period. Account holders generally review their bank statements every month to help keep track of expenses and spending, as well as monitor for any fraudulent charges or a mistake. The second entity is the depositor statement. Depositor statements are likely the items that the bank has recorded, but the items are not yet recorded in the company's general ledger cash account. Books of accounts are key to bank reconciliations. This is where a company records its business transactions. Entities of each part. Bank statement. Their entity are the following: deposit in transit. Deposit in transit will be added by the bank statement. Outstanding check will be deducted from the bank statement. Bank errors, it's either add or deduct from the bank statement. On the other hand, the depositor statement, bank service charge deduct, NSF or the not sufficient fund, checks and fees deduct, check printing charges deduct, interest earned add, note receivable collected by bank add, error in company's cash account add or deduct. Now, let's proceed to the application of what we are talking about earlier ago, the bank reconciliation. Here is an example of bank reconciliation. XYZ company is closing its books and must prepare a bank reconciliation for the following items. Letter A, bank statement contains an ending balance of 300,000 pesos on February 28, 2018, whereas the company's ledger shows an ending balance of 260,900 pesos. Letter B, bank statement contains a 100 pesos service charge for operating the account. Letter C, bank statement contains interest income of 20 pesos. XYZ issued checks of 50,000 pesos that have not yet been cleared by the bank. Letter E, XYZ deposited 20,000 pesos, but these did not appear on the bank statement. Letter F, a check for 470 pesos issued to the office supplier was misreported in the cash payments journal as 370 pesos. A note receivable of 9,800 pesos was collected by the bank. Letter H, a check of 520 pesos deposited by the company has been charged back as NSF or not sufficient funds. In making the transaction of bank reconciliation, so number one is make a heading that includes the following: company's name, account name, and the date. The example is there. XYZ company is the company's name, account name is a bank reconciliation statement, and March 31, 2018 is the date. The second process or the second step in making a bank reconciliation is to identify each transaction if it is a bank statement or a depositor's bank statement. For the bank statement, there are the cash or ending balance, the letter A, the letter E, deposit in transit, letter D is the outstanding check. On the other hand, the depositor's record are the following: letter A, depositor's balance, letter G, receivable collected from the bank, letter C, interest earned, letter H, NSF check, letter B, the service charge, and letter F is the error check. For the third process or step is apply each transaction if where they belong. For the bank statement, the cash balance amounting to 300,000 pesos added by deposit in transit amounting to 20,000 pesos. So 300,000 pesos plus 20,000 pesos is the total is 320 pesos. Deducted the outstanding checks amounting to 50,000 pesos. Then the net total is 270,000 pesos. After making the bank reconciliation on the bank statement, the net total is 270,000 pesos. For the depositor's record, depositor's balance of 260,000 pesos added by receivable collected from the bank amounting to 9,800 pesos added by interest earned amounting to 20,000 pesos. So 260,000 pesos plus 9,800 pesos and the 20 pesos is the total is 270,720 pesos. Deducted the NSF check or the not sufficient fund check, service charge, and error on check. NSF check amount to 520 pesos, service charge amount to 100 pesos, error on check amount to 100 pesos. So 270,720 pesos, deduct the 520 pesos, 100 pesos, and 100 pesos. The net total for that is 270,000 pesos. Now, finalize the transactions. That is the final step in making the bank reconciliation. So as you can see, this is the final transaction. XYZ Company Bank Reconciliation Statement as of March 31, 2018. For the bank statement, the total is 270,000 pesos. And on the other hand, the depositor's record, the net total is 270 pesos. If the bank statement net total and the depositor's record net total is balanced, then your bank reconciliation is correct. And that's the end of our discussion and session for the bank reconciliation. Thank you.